Let's continue. Let's talk about uncollectible or bad debts. This is the situation when the client did not pay, and so your accounts receivable becoming worthless. So what to do and how to record it? So if it is the case, the easiest way is to directly write off your bad debts. Let's look at this slide at the left hand side. So you first record your credit sales, so you record your accounts receivable, your asset, debit, and you record the revenue that is smaller than that and GST clearing. And after that, you write off your uncollectible debts. So you will debit bad debt expense, which is expense account, against accounts receivable. And of course, your bad debt expense may be smaller than accounts receivable if there is GST in that country. And that's it. However, suppose the financial year will finish and then we enter the next year. And what if in the next year there is the debtor decides to pay, found the money and decides to pay on the accounts receivable. So you already recognize bad debt expense and you cannot just go back to your previous financial statements and revise them. In rare cases you can, but you cannot do it on a regular basis. Basically, 2 years from now, reconsider your previous financial statements. It is not a typical practice. And so in this case, once you write off your accounts receivable and then you make the opposite thing in the next year, you will be causing the situation when your profit and your expenses are moving up and down across the years, becoming very erratic. And of course, it's not desirable. Your financial statements will not look good if you directly write off the bad debt expenses. So unless your expense is very small, you do not do this method. You do not adopt direct write-off method. And also, when do you apply direct write-off method? When you know what particular client will not pay on the accounts receivable. If you know that, then you do not need to make any estimates like in the other methods. You just you know who will not pay, who did not pay, and you write off this bad debt expense. That's it. So no estimates will be involved. However, if you do not know who will not pay, how many of them will not pay, then you need to make an estimate. And for that, you need to use allowance method. So for allowance method, all your write-offs and reversals of the write-offs will occur within same year. So it's not going to be across the years. So all the things related to the bad debt expense will be settled and closed within particular year. And at the end of that financial year, you will prepare the balance day adjustment, debit bad debt expense against allowance for doubtful debts. Let me go back for a moment to direct method. Let me mention the reversal of the write-off. So when you write off, you credit accounts receivable and debit bad debt expense. But when you reverse them, when you make a reversal of the write-off, then you will reinstate your accounts receivable and you will cancel the bad debt expense. You will credit bad debt expense. And with the direct write-off method, you do not do anything on the at the end of the financial year at the balance day. You just sometime during the year you will write off the uncollectible debt. And then next year you may reverse this write-off, and your profits are jumping up and down. It's as I said, it's not a proper way of writing off the debts. With the allowance method, everything will be settled within one financial year, and on the last day of the financial year, you will make this balance day adjustment. So bad debt expense is an expense account. It has normal balance debt. What about allowance for doubtful debts? Allowance for doubtful debts is a contra asset account. So you remember, if we talk about depreciation, there is asset, the asset, equipment, for example, it has normal balance debit. And when we do depreciation, we put credit accumulated depreciation. Accumulated depreciation is a contra asset account that is reducing the value of asset. Same here. You have receivables, and the reduction of receivables, the contra asset account, would be allowance for doubtful debt, and therefore its normal balance is credit allowance for doubtful debts. So with allowance method, you record the credit sales and debit accounts receivable against service revenue. When you write off uncollectible debt, you will credit accounts receivable and do debit allowance for doubtful debts. And then you will reverse the write-off, and the reversal of write-off is the opposite of the write-off. So you will debit accounts receivable and credit allowance for doubtful debts. Just ignore GST for the time being. So here you need to make, as I mentioned, you need to make an estimate of your bad debts. You do not know exactly who will not pay the bad debts, how much they will not pay. You need to make an estimate. So one way to make an estimate is to look at historical data, how many of the debts were not returned, how many of the credit sales resulted in non-payment. So you will look at historical data and extrapolate it into the future. You will think that this year it would be similar or in line with the previous non-payments. And so you will then multiply your credit sales by the proportion of non-payment. And you will find the value that you will put here. Debit bad debt expense and credit allowance for doubtful debts. It is an income statement approach. So for example here, so there was in the previous years credit sales amounts not collected. So average non-payment over the years was 1%. And you will apply this, sorry, no, not 1%, 0.5%. Yeah, and you will apply this 0.5% to this year amount of credit sales. So this year the credit sales were $300,000. You multiply it by 0.005 by 0.5%, and you will find that non-payment of debts would be only $1,500, and you will debit bad debt expense $1,500 and credit allowance for doubtful debts $1,500. So it seems like it's all easy. It's all easy, but this method will not really recognize what happened during the year, because during the year you may have situation when you wrote off the debt and then the client actually paid the debt, so you reverse the write-off. There may be multiple transactions during the year, but you just ignore them with the income statement method. Therefore, it is not a precise method. It will achieve the matching of revenues and expenses in contrast to the direct method. With direct method, we do not do it, and that's why profits are jumping up and down. Here, it will not be the case. You will achieve the matching, but the method will not be precise. And also, it would be based on the assumption that the previous non-payments extrapolated into this year. So if in the past, 5% of the accounts were not paid, then the same would be this year, but it doesn't have to be like that. So therefore you can, as I said, method, the income statement method, or otherwise percentage of sales method is not precise. You better use some other method that will be more precise and will consider the write-offs and reversal of rights or of write-offs during the year. And this method is called balance sheet method, percentage of receivables method. But it will be more complicated. So you will have, let's have a look here. First of all, you will do the aging procedure. So you see that here there are different accounts receivable. Some of them are overdue by 30 days, some of them overdue by 60 or more than 60 days or more than 90 days. And then you can find the estimated percentage uncollectible for each period of non-payment. And you will see that if the account is overdue only by 30 days, the non-payment is only 4%. But if it is overdue by 90%, the non-payment percentage is 40%. In other words, if the account is overdue by more than 90 days, we could easily say that a large part of these accounts would never be paid. In our case, 40%. Then you can estimate the total bad debts. This is the estimate, of course. So in our case, it will give us the desired balance or closing balance or estimated balance in the allowance for doubtful debts account. Let's have a look here. So, allowance for doubtful debts. This is accounts receivable ledger. You can easily prepare. It's not a big deal. The opening balance is debit, and you will do the write-offs and reversals of write-offs, so you can populate this ledger. How about allowance for doubtful debts? The opening balance is credit because it's a contra asset account. So when there are write-offs, you would record them on the left-hand side. When there are reversals, recovery of the previous write-offs, you would record it on the right-hand side. You will get some unadjusted balance here. You will compare it with the balance that we want, this balance that we got from the aging of receivables. So this balance, 2,228, is the balance in allowance for doubtful debts that we want to have. And this balance, opening minus write-offs plus recovery of write-offs, is unadjusted one. So if you want to find the bad debt expense and the adjusting entry that we mentioned here, so your task would be to make this adjusting entry. Debit, bad debt expense, credit, allowance for doubtful debts. You need to put some figure here. So how do you determine this figure? With the income statement method, we just estimate percentage of non-payment on the credit sales and put the figure here. If you do the balance sheet percentage of receivables method, then what you're gonna put here? How you determine the figure here? So you will get this balance, desired balance, the one that we want to have. We will compare it with unadjusted balance. Here it is 3,100 minus 2,200, and you will subtract this balance minus balance that you get here, and you will get the value 2,900. 2,900, and therefore you will put this 2,900 into here. Debit, bad debt expense 2,900, credit, allowance for doubtful debts 2,900. Okay, and that way you would be able to capture all the transactions to your allowance for doubtful debts and receivables that happened during the year. Let's continue later.